So, in the world of personal finance, we're always trying to find ways to cut costs and save ourselves a dollar. And in that equation, often insurance comes up. Insurance, cable, phone charges, all those things. Well, from the insurance side of the equation, how is it that we can actually think about trying to save ourselves some money in the insurance world? Specifically, let's talk about home insurance and auto insurance. Well, hey, I'm Landon. I have had a decade of experience here in the insurance industry and have helped clients all over the world in over 60 countries with their insurance needs. And today we're going to talk about my 6 tips on how to save money on your home and auto insurance. So before we get into some of the details of what I'm going to share with you, I want to break this conversation up into 2 different segments of ways that we can look at affecting the rates of your insurance policy. So let's develop 2 distinct buckets of ways that we could potentially save on that home and auto insurance. I like to think of it as long-term and short-term. Because saving money on your auto insurance does take time, and there's some things that you can do over the course of your life that will generally lead to lower insurance premiums. And then there are probably some things that you might be able to do right now that would help you reduce your rates moving forward. So my first tip or area that we're going to talk about is your credit score. So number 1, credit score. It probably would come at no surprise to you that your credit score is going to affect the insurance price that you're going to pay for home and auto insurance. The relationship that you have with debt, let's actually write that down. Its credit score is really your relationship with debt. And so what the insurance companies are looking at is how well do you fulfill your obligations. If you are a person that's maybe not always up to date on their payments against debt or, keeping things current, then the insurance industry is going to look at that and say, maybe this person's not a great risk for us. And so in order to make sure, we have to provide them some kind of coverage. So why don't we just charge them a little bit more for that coverage? And oftentimes that's exactly what ends up happening. So in the scope of your life, what you could do are 2 distinct things that can help you maintain a really quality credit score. And those would be, make sure you make payments on time. This is obvious, but if something is due on the 1st, let's pay it within that grace period. Let's just keep those things moving. These are unforced errors, if you will, if you can afford it and just don't make the payment. Now, if you are struggling financially to make those payments, that's a different conversation. What I'm speaking to mainly is let's just make sure that we stay up with what we can to help keep the credit score as high as possible, which is obviously lowering our insurance cost overall. Number 2 would be don't open accounts you don't need. And by this, I mean credit card accounts or extra bank accounts or any kind of loans or things that you think would be nice to have. Financing, anytime you have a credit check, if you're financing furniture, if you're financing whatever it is you're trying to get done in your life, that will affect your insurance score ultimately and your credit score more directly. So over the course of time, it's just best to try to keep that credit score as high as possible, and that will help drive down the cost of your insurance. So number 2, kind of the second way that we can try to save some money in a long-term fashion is manage your claims. Don't file lots of small claims. Small claims will eat you alive. And by that I mean the insurance policy that you have, whether on your home or automobile, is really broadly for catastrophe events. Those events are often sudden and accidental. The insurance industry wants you to live in the world of, hey, if I total my vehicle or if my home is completely burned down, I will obviously file an insurance claim. But if a small piece of siding comes off or we have a chip in our windshield or something small occurs to our vehicle or home, those small claims lead to something called claims frequency. So claims frequency. So in general, the more frequent that you have claims, the more expensive that the insurance will be. You could have very small claims. You could have maybe 3 claims on your auto insurance. One is a $200 windshield, and the next one is a $700 fender bender. You bumped into a shopping cart, and maybe the last one is an actual accident where you actually had a problem or backed into someone or someone hit you, and it was determined that you were somehow at fault. Every one of those claims will stack on top of each other. And depending on the state that you're in and the driver incentive plan and different things that you have, your claims frequency can go against you. The first claim may cost you a 30% bump. Then it may go to, if you have claim number 2, 120% bump. And then claim number 3, 240% bump. And those bumps are off of the base rate of insurance that you're being charged. So understand that small claims, catastrophe events, sudden and accidental issues, but claims frequency itself is a major, major driver of the overall rate. The more you have, the more expensive it's gonna be. Number 3, and I'll try not to run out of space here, but this is to bundle, which you've heard many times, and combine. Now, I really want to get into this one a little bit further because obviously bundling insurance is something you've heard of time and time and time again. But there are many situations out there based on your life and how things are going in your life. By that I mean maybe relationship status or, kids getting vehicles or whatever, that can really affect the way that the insurance company is able to support you in your insurance policy. So let's take an example. Many of you out there have a spouse, significant other that keeps finances separate from you, or you keep finances separate from each other. Great. You've decided that you're going to keep your finances separate. What I want you to understand is some of you will also have a separate insurance policy for each other with a single vehicle on each, just to keep things simple and keep the policies separate from one another. Now, you can do that. The states often let you do that. State law does. But I guarantee you, and one thing that a lot of people don't realize is that if you put 2 vehicles on one policy, or have a home that maybe one of you has got their name on and then the vehicles are paid for by someone else, if those were all together, you are going to maximize the available credit that the insurance company is able to give you. What do I mean by that? It's not just because they feel like it. Okay? Insurance companies often have to file with the state that you're living in exactly how their rate structure is supposed to work. And one of the ways that they can keep the cost down for consumers is to have everything combined together. And so when they do that, that gives you the option to actually keep things all packaged up nice and neat in one company if you can and save some money. Now, there may be some other scenarios in combining or moving on from certain things. So another long-term strategy here to save money is don't insure things you don't need. If you have an extra vehicle laying around that maybe you inherited or you've had forever, but it's driven very little, and maybe you do that with your first vehicle and your second vehicle and your third vehicle, and all of a sudden you got a parking lot in your garage, that will cost you, obviously, a lot of money to insure. The insurance companies want to see relatively similar drivers on the policy compared to vehicles on the policy. If you have 2 drivers and 2 vehicles, perfect. They know exactly that those people are probably using those vehicles for commuting or for things that they need to do. Now, if you have 2 drivers and that's it, and 5 vehicles because you've got a truck and you've got a sports car and you got your Sunday car and you've got your commuter car and then maybe your significant other has a car, then the insurance company looks at that and says, they like to drive, which is obvious that they're going to then charge you more because the likelihood that you're going to jump in one of those vehicles and maybe be a little less careful with it could be higher. So at least that's the information that they feel they have. Therefore, it might be time that you sell some of those assets off. If you don't need it, it's not an affinity thing for you. You just have it to have it, or for maybe a security blanket. Maybe it's for fun. If it's for fun, I understand, and you probably understand that you're going to pay a little bit more in insurance anyway. But in general, if you can sell something and move it off your books, that's going to work out well for you in the overall cost of insurance. All right, so that's all the long-term strategies that I have for you today. But as we think about how to get your insurance cost lower, what are some short-term things? What are some things that you could do right now, today, to help you affect the rate and maybe lower that cost a little bit? Well, let's start by very first thing is review everything. Review, and I would say every other year. All right, now it's very important that you review your policies. Every insurance person that you would talk to is going to tell you that. And it is important, but the frequency by which you are reviewing that is also important. Your life can change. And it may be that at one point in time, you needed a very, very low deductible policy. Maybe you're a student and you don't have a lot of money and you don't have a lot of savings. And so if something happened to your vehicle, you want it to be able to be covered without a lot of money out of your pocket. I understand that. And so you may have a lower deductible structure, but then you're obviously trading off for a little bit higher insurance cost. Well, conversely, as you sort of age up or mature into your professional life or start making more money, you may be able to afford a higher deductible if something actually happens to you. And so reviewing the policy to see, does the deductible structure still match my lifestyle, is kind of very important. If you increase deductibles, you will lower the cost of the coverage. So think about this in terms of, keeping, this isn't a set it and forget it kind of thing. It's not an easy bake oven, okay? You've got to stay involved with it to make sure that these things are in the proper alignment with you. The other thing that can happen, especially in homeowners insurance, is you may have a property that's been insured for several years. And as you kind of move on with life, there's something called an inflation guard on the policy. That inflation guard basically allows the insurance company to protect you in some ways, and in other ways make sure that you're not underinsuring a property. So every year that your policy renews with an insurance company, that inflation guard will go up by X percentage. It's kind of all over the map. Sometimes it's 2 to 3%, sometimes it might be 5 to 6%, but it will go up. Your property value is going to go up. And obviously over time, that's to protect you as the customer, because you might insure a property right now for $200,000, but in 10 years from now, you hope that that property is probably worth more. So the insurance company is constantly increasing that inflation, or that rate, the amount of insurance that you have on the policy. But there are times when the inflation guard inflates the actual insurance coverage itself. And that's because every year you don't think about it, every year you don't review it, it may be too high. So what can you do? Get with your insurance agent, review that policy, have them rerun a replacement cost estimator, replacement cost. That's very important. And see if your property is still in the proper alignment that you need for the overall building and what it is that you hope that it is insured for. Number 2, you have heard this many, many times. It's not the most important thing, but often consumers think it is. And that is, I want you to shop, but don't flop. And by that I mean, it's good, obviously, to review your policy. It's good to see what the market can do for you. But I again use the rule of thumb that this is probably an every other year, every third year exercise. The reason being, there are insurance companies out there, specifically in the auto insurance world, that offer 6-month policies. Every 6 months it renews, and every 6 months the insurance company probably raises the rates, and that really makes you mad. It makes me mad too. However, if you were to move your insurance every single year, all the time, 2 things are going to happen. 1, you will never gain enough insurance experience with a single carrier to which the insurance company that you may want to work with right now would say, yep, they understand insurance. They're not going to go anywhere. We'll go ahead and take this risk. I mean, you may have an accident year 1, but if you stick with them for 4, 5, 6 years, they will still have returned premium enough, or you would return a premium to them enough to offset whatever loss or claim they may have had to pay for. So that's reason 1. Reason 2 is the insurance companies cannot give you a discount if you flop around from company to company. Continuous insurability is important, and it factors into the overall insurance score. So the longer that you stay with one company and then decide to move, the better for you overall in the race. So if you've been with one company for a very long time, it might be time to go ahead and review it, shop it, see if you can find something else. If you haven't, it might be time to just chill. Maybe we just changed. You don't don't want to change every 6 months. Finally, the third short-term tip that we need to do is my recommendation is always to work with an independent insurance agent. Now, what does this mean? An insurance agent itself is many things. There's many different insurance agents out there. You may be familiar with a company like State Farm or Allstate or some other larger companies. Those companies have agents that really only sell that product, that one thing. Independent insurance agents can often sell many different types of companies in many different ways. And so an independent agent often has their finger on the pulse of the insurance market in general. And it's important that you work with someone like that because they obviously are kind of head on a swivel when it comes to which companies are working for this type of risk now or in the future. So find an independent insurance agent, just Google that wherever you are in your city and town, and you will find a great list, usually a really well Google reviewed list of people that I think you should work with. So I know I kind of packed a lot into this one video. Feel free to skip back around and wherever you need to go within this video, replay whatever you need to kind of understand what my suggestions are there. But suffice it to say, there are things that you can do in setting up your life, that long-term strategy, that would be important to the overall insurance costs that you're going to have to pay. And then there are certain things that you could probably do today, tomorrow, next week that would really set you up right now for a great policy in the near term. And then hopefully you're working on these long-term strategies as time goes on. So I very much hope that this was helpful for you. Thanks for watching this video. If you liked what you saw, please click subscribe. We look forward to delivering the next message to you here very soon.